One of the biggest worldwide economic indicators is now flashing red. Hello, ladies and gentlemen, and welcome back to the show where we talk about stocks, commodities, and cryptos. We've got all the key levels for the week ahead for you to be taking a look at in today's show. But more importantly, we need to discuss some of the macro things going on. Inflation is up. Core PCE came in very, very hot. Markets hated it and initially sold off with some recoveries into the end of the day. With so many of these weak recoveries, what does this mean about the potential of a rally? Well, today we talk about rallies, dumps, and also the seasonal data that is ahead of us for March. Stay tuned. Well, welcome back everybody to the Daily Show. This is our special weekend edition. We're going to be talking about the news, the key levels, the biggest macro data, and of course the hottest charts. But let's get started with the US consumer spending because it posted its biggest gain in nearly 2 years. Inflation is heating up and it's here to stay, at least for now. Now, the biggest problems are consumer spending. It increased 1.8% in January. People are feeling rich, but we've got the examples of why that shouldn't be happening, but it is in just a few moments. Income climbed 0.6%, wages to 0.9%, and core PCE price index was up at 0.6% instead of 0.4%. So what's the problem? Well, people have been spending the last couple of years due to stimulus, and they're feeling rich. The problem is, turns out that most of them are not actually rich, and we can see this in US credit card balances nearing that $1 trillion mark. Basically, people are spending on credit now. They believe the Federal Reserve's got their back, the government's got their back. The unfortunate truth is this time they cannot afford to have their back, and it's going to be higher rates for longer, which means people are going to need to pay back credit card debt on higher interest rates. Once people start to wake up to this, and also around the world, some mortgages will become more expensive, this is going to hurt the economies. And I think it's clear that eventually this will rile over into earnings, and you just got to be, it just makes common sense. It's a problem and you can see it's out there. So why have markets rallied recently? Well, it's partially because technically this is bringing in more profit for companies for now. This is a very delayed response to the inevitable recession we're going to see in the US. Yes, I still believe it. Bonds market tell me so. We're not here to say, is it my opinion? Is it your opinion? It's realistically the opinion of the bonds market. And we'll explain that later on in today's video if you're not aware why. But here's the liquidity. The government's liquidity, as in the big six, Fed, ECB, Bank of England, Bank of Japan, Bank of Canada, and People's Bank of China, they're all injecting at the moment, even though they're not saying they are. They claim that it's tightening. Well, People's Bank of China is definitely injecting, but effectively it's getting a little bit easier to get money. This is partially why everything's going up. I expect this to revert, as in it will actually switch around. They're going to have to tighten again, and this is a mistake again with central bank policy that's going to end up causing a longer, big problem in all of the economies of the world. So the stock market's currently thinking it's all good. And you can see the current run versus a recession run. So if there's no recession, we tend to just continue to grind up. If you're part of the bulls, which is totally fine, there's definitely a case to be made for both. We looked at it in our previous video. In fact, most economists, they're split like 40% in terms of width of how they are thinking this year is going to turn out. Some believe it's going to be negative 20% on the SPY. Some believe it's going to be positive 20% on the SPY. So everybody's disconnected. Nobody really wants to make necessarily the call in the middle of neutral or anything. It's either really bullish or really bearish. Well, the markets are following the really bullish sign where we skip the recession. In recent weeks, we've seen the reasons why that may not occur, but we need to keep the data in mind as well. When did we start to fall off? Around the 15th, 16th of Feb. Now, is this normal? Well, yes, it's annual seasonality. So we do tend to fall during this period. We tend to fall into March, and somewhere in that middle or start of March into middle of March, we tend to see rallies. Now, those rallies can be pronounced for a few months, and then in Q3, things start to get nasty again. So is this expected? Well, yes, it is. Traditionally, this is the type of thing that we do see appear on the charts. Now, I want to bring up some other things that we've seen recently. And this is the switches of course, yield. Now, I posted about this over on our Twitter, follow at FX Evolution. Links in the description down below if you're interested in that type of stuff. And what we've seen is an incredible increase in rate yields and way less cuts on the horizon. Now, this is bad for gold. So gold's getting smashed. This is great for the US dollar. which is why we've been so bullish US dollar recently and why the markets have switched. And it's also bad for, of course, high growth stocks, and it's going to be bad, you would think, for property as well. So effectively, all of these things, although they'll be different in terms of reactions, will end up being affected if this is the way it's going to play out. Look at these yield cuts. It looks like we're basically not getting any pivot. This is a Fed pivot, according to the market, until maybe the end of 2023, but most likely 2024. So this means that there's no pivot this year, according to the bonds market at this stage. This is a drastic shift from where we were back in December. You look at the December rate, you look at where we were, we're higher for longer, we're less cuts, and we're higher terminal rates, which means the highest rate we're getting to. So make sure to go and follow us over at FX Evolution if you're interested. Another one that I posted here was our old copper chart. Now, you'd know, and we'll bring up copper a little bit later on, that they call it Dr. Copper. This is the economic health indicator. Now, I've been pretty bearish on copper for about 2 to 3 weeks now, and there's a good strong reason why. It tends to play out this time of year. Well, we're coming into March and we just got a new low. So copper's starting to, really heighten up. It hit some critical zones that I believed were short. We saw that kind of rally. We saw a huge dump through the last couple of sessions, and copper is showing us that we need to be a little bit concerned about the economy. So let's go back to the data, because again, our opinions don't really mean much. What we need to be looking at is, does this make sense to the time of year? Again, middle of February into that middle of March, we tend to see spikes in what? The fear index, VIX. So the fear index is spiking, and at the same time, the market usually goes down. Well, that's what's happening again. If you have a look at Q3 as well, that's where we expect it to happen again. Now, could that be where we start to think about that recession word again? Because I don't think recession's going to really be thought of for a little while right now. Hot economic data, etc. Look at the jobs numbers. We believe that usually with jobs numbers, about 6 months before a recession is called, jobs numbers effectively should lessen, so therefore unemployment should go up. We haven't even seen that yet, not a sustained unemployment run. We know that big tech's firing people, but we're not seeing it in the broader economy. What about smart money versus dumb money? Well, this is obviously shifting at the moment. Now, you might say, well, smart money are buying up. It always happens. Look at this. When you get dips, you get smart money buying up. It's whether they sustain those purchases. So you'll notice here that basically by the time the market had bottomed, smart money was buying the highest level they had been purchasing. And then we saw a shift, and then they start down purchasing as it rallies through and let dumb money take over. So we've seen that again. This is one of our partial tools that we use along with other confluence techniques. And it's kind of nice to look at the examples, but you can see here that retail are starting to lose confidence. And yeah, I mean, rightfully so. Of course, some of the data is looking pretty bad out there, but we're coming into some critical zones, if not the current level we're at, that could show you some rally zones and rally levels. Let's move over to what the rotation was for the session. So it wasn't really defensive. It was a little bit better than you'd expect in the defensive side. Obviously, financials doing better, utilities doing okay. They both do okay technically in higher interest rate environments. You also have, of course, staples coming back up and holding. So expected things. You do have metals up here as well, which is expected when you have a higher longer term interest rate. XLP now for the last 5 days is the standout. XLU and XLV, these are the 3 defensive sectors we look at on this channel. They're some of the best performers the last 5 days, which makes sense because as the market goes down, Wall Street will tend to jump into what they consider defensives. And from this period into usually the middle of March into late March, you do tend to see those utilities, staples, and even healthcare sometimes do better than the market as a broad whole. So just before we jump into the charts and all the key levels that you should be looking at for the week ahead, I want to say a big thank you to the sponsor of today's video, which is of course Tiger Brokers. Now, Tiger Brokers are offering a whole bunch of special offers in the description down below. Additionally, for FX Evolution community members, you can get an extra $15 Microsoft stock. Yes, I love Microsoft. For as little as 1 cent funding if you're from Australia. For other countries, check out the description. But one of the things that I want to mention about Tiger Brokers is obviously their commitment to constantly increasing the features that they're offering you as traders and investors. Now, if you're from Australia, it can be incredibly tough to trade the American market. Of course, my opinion, the greatest market in the world to trade. Pre-market and post-market for a 16-hour total is available within the Tiger Brokers platform. So if you're interested in trading stocks like Tesla, Microsoft, Apple, and others, you can do so. Whether it's from quotes and level 1 and level 2 data, whether it's from tickers, whether it's ability to do the analysis, get the 12-month targets from, of course, Wall Street's big players out there. You can do all of these things inside the Tiger Brokers platform and more. So if you're interested, check them out today. Check out the description. Let's get back into those charts. So let's get back into the charts and let's take a look now at the VIX. And the VIX was not really up that much, considering overall week was actually down for the VIX. We're not really using this as much as we were because of these 0-day expiry options, but we do know that this is a time where we expect VIX to spike up. Let's have a look at yields now. So terminal rate, this is basically the August period to September period. This is the September call for the highest interest rate that the US is going to get to. Now the bonds market's starting to wake up and say, well, maybe we're going to go a little bit higher. This is actually the December one. Let's move over to the September one. 5.4% new highs. December still 5.3. So basically no cuts in 2024 and 2023, I mean. So there's no cuts coming. And this is not really that good for the markets. It's not good for, I think, the American consumer, which remember is 1/3 of effectively the GDP. So 1/3 of the GDP, 1/3 of the economy is realistically the American consumer. If it gets sick, it's not going to be good. Let's move over to TLT. Higher interest rates, not good for treasuries. Treasuries move down a little bit. I still like treasuries down here. And again, you know, at some point we will hit terminal rate. Will that be 6%? Kind of where Goldman's starting to say it was. Remember, Goldman Sachs came out and said 75 basis point increases. Most people are now starting to say, well, we could be going to 5.75 to 6. I tend to believe that this is possible, although I think something breaks if we go that high. So remember, the Federal Reserve will not pivot, then cut out of the goodness of their heart. They're cutting because they broke something. And I've done this chart a lot of times. They always break something when they do these hiking cycles, and it always goes bad for them. So just remember, they'll break something this time, and that will turn out to be bad. The question is timing, and you've always got to have that in the back of your mind. You can still see epic rallies, but something will break, something will offer, you know, probably potentially cheaper valuations. Now, I posted over on Twitter one of the things I like to look at, which is forward PE. And forward PE is not cheap, but we actually dropped almost an entire 1 point over the last week. So we're getting closer to that average of 16.9 kind of over the last, 20, 30 years. Now, we're still in the 17s, but overall, it's getting closer to the mean. Now, if we get one standard deviation underneath, well, then markets are becoming cheap. Now, some people say they can always get cheaper. Of course they can, but you've got to have a plan. And what is your plan going to be? Make sure you have investment plans, trading plans, and swing trading plans as well. You've got to have separate accounts, or at least separate ideas for each one. And we do try to cover a lot of that here on the channel. Let's move over to HYG, which is junk bonds. Now, we know that junk bonds traditionally have shown us the way in 2022. They're currently showing us the way in 2023. These are trash. They're called junk for a reason. And they found a little bit of buying actually through the last session, which is surprising. So they're off their low. They're kind of detailing that maybe we've got a little dip purchase coming up. But overall, yes, they showed us weakness during our consolidation. That helped us to say, okay, yes, these markets are going down. And of course, so far they have, along with our seasonality and everything else. Remember, the confluence is the key story. Now, this is one of my favorite charts at the moment. It's the DXY, and I'll give you guys a clap because congratulations if you've been running the DXY bullish. It's very glorious. So yeah, again, understanding the dynamics of yields increasing, US dollar becoming much more hot, and of course, fear jumping into the market, which makes US dollar the best currency in the world, remember, at the moment. The number one to go towards for yield and just risk-free rates. So overall, it's in our zones, in our area where we could see the US dollar start to struggle. Now, I've put a little watch reaction here up in the supply area top end. If we do end up continuing to see the US dollar go strong, these could be zones where you see US dollar turn for a little bit, or at least start to consolidate. And at the same time, you may also see the market, that is the stock market, be able to rally if the US dollar is starting to weaken. So we're in the zone of a potential turn here for the DXY. Critical level, 105.25 was our target. And I'm going to say that we did a damn good job because it stopped at 105.27. I still think it could go higher, but yeah, hit those critical levels. Let's move over to gold. We've been negative on gold recently. I'm actually a massive gold bull. However, yeah, you can't be a gold bull when yields are going up. That's not a good idea. So gold is getting smashed and it probably continues down. I don't see any strong purchasing coming through here for gold at this stage. It continues to weaken. It's just a downward trend for it. I mean, there's not much to say other than that. I've got a little level down here within the 1792s. I'd like to see gold come back into this structural zone. And then again, that could coincide well with that DXY. So they're probably going to be a combo. At the moment, gold's kind of signaling DXY maybe going up more. But I expect and I hope to see gold down here. Now for long-term gold bulls, because there's a real case for that, these levels are starting to get a little bit better. Now, a lot of you hoped and wished that we would see gold back at these zones. I said at the end of January, I was like, no, gold's not good now. And the reason why is because of many things, but we ended up getting even luckier because, of course, inflation started to poke its ugly head out and that turned out bad for it. But we're back at basically halfway through this epic run that's the way up. If you believe that interest rates are getting close to their highs, gold's a very interesting longer-term play. Now let's move over to the topic of today's discussion, which is Dr. Copper. This thing is weak, and I mean, it looks horrible. Now, I've been on the record really hating on this one. I said this is one of my highest conviction trades. And the reason why my personally high conviction trades was because we hit a critical zone at a critical time, and I just didn't believe the economies were super strong. Now, that doesn't mean copper's going off into the ground again. I don't know that. I mean, of course, China stimulus was more of a buy the rumor. We now know that the stimulus is everywhere over there, and they're not going to stop that stimulus, so don't expect that to do anything. However, it's going to hurt the rest of the world now because it's like inflation kind of going everywhere now. They're basically ruining all of the Fed's work and the ECB's work and everybody else. So it's counterintuitive what's going on in the world. We saw the 61.8 retracement fib get rejected. It's now made a new low, and there's no reason for us to believe at this stage, based on what we're seeing on copper, that we're feeling bullish about this particular thing. And I'm looking for copper back into the 370s. Now, if that happens, again, it just proves overall that there is a sickness in the economy. And if copper continues to get driven, maybe you don't trade it, you don't have to trade it, but you just need to realize that copper is an economic health. It goes into so many builds, it's so heavily used. If it's weakening in price, I usually say the metals traders, they know what's up. And if they see something, well, you've got to be a little bit concerned. And at the moment, copper's starting to do that turn. Let's move over to natural gas, maybe a better story. There's a great weekly close. We had the roll of the contract, we had lows getting taken, and then we saw a massive resurgence in oil or natural gas or whatever you want to do. Now, I always say this is called the Widowmaker. Those exchange traded funds that I've seen so many people getting interested in, they're actually futures contracts underneath with rolls. They have real degradation in them. Just load them up onto a chart. It's not hard to see. In fact, if I load one right now, so let's load oil here as an example. If I put that on a monthly, does that look like the kind of chart that you're like, whoa, yeah, that's awesome? No, it degrades over time. It's a derivative, yeah? So you just got to remember that these are risky positions, especially in the old natural gas. But if we look at it on all of the surfaces, we can say, okay, well, was this the final sell? Everyone kind of gave up. We'll be looking for closures above 270. I still think there'll be a drop after that. And then again, that kind of classic inverse head and shoulders style move or classic kind of accumulation move could occur. We will be watching this. I'll see if I can get some reports on what the big players are doing. So make sure to subscribe if you're interested on what's occurring with natural gas in the next couple of weeks. Let's move over to Tesla. Now, Tesla didn't do that much. In fact, it held up, I think, okay, considering this sell. Down 2.57. Now it's got some gaps on it, like here, which is that last previous close, which sits around 202. I've updated the expected weekly options highs and lows for you guys. Basically, these are ranges that you can attach and confluence zones that you can attach to your resistance, your support, your supply, your demand. Extra information, as long as it's separate, is always good. So here we have the high, the low, we're in the middle. it's going to move with the market, I feel, but there's a lot of latent demand in here. Anything that has any word attachment to AI right now is detached from reality. Now, notice this, 196. Look at that. 195 was maximum pain. Now, this is not a week that I would have traditionally gone for maximum pain. I always tell you the third week of every month is the one that you actually even pay any attention to it. But what it does show you again is, although conventional theory is, of course, there has to be hedging done by the street and all this dancing around to try to, accommodate all these puts and calls. Other than when it gets extreme, they do a great job of closing it in the middle zone so that they have smiley faces. So, people disagree with me about put walls and call walls. I'd be interested to know what you think in the comments down below. But I do believe that they don't like paying off these big strikes, and they don't traditionally do it. So these two zones, 190 and this zone here, we're unlikely to get paid during the week. And of course, they didn't. Let's move over now to the third. So this is the coming week. We know that there's 220 calls, which are relatively large, and then we've got the 200 calls. So again, kind of trapping that upside. As we go up, we know where we've got the big zones, and the puts have actually been lessened. So there's a lot less, structurally huge puts sitting there, and it opens up the case for maybe the market to continue to go down on something like Tesla. Now, at this stage, I still think anything with AI has got a lot of latent demand in it, but I expect Tesla to eventually get back down to these zones here, that 140, 146. And if it continues to maintain kind of this type of thing over here, I keep thinking it could be selling into a dump. So be careful. Tesla's one that if you're day trading, that's fine. But if you've got longer term plans, I don't see why this gap will not fill at some point. And then we can talk about, well, what happens next. But be careful out there, guys. It's certainly a one to watch. Let's move over to Apple. What's going on here? Well, again, we've got expected highs and lows coming out. We've got a gap fill that didn't quite fill. So no fill yet in terms of the way I see it. And we still know that this big resistance zone here at the 156, that's remaining intact. So Apple doesn't look good on a chart, nor does it look really that great in terms of tradability. I was surprised that we ended up going down, but not really. I mean, the inflation number was so bad and the market wasn't going to ever like it. Yields went higher for longer. And what I was actually more surprised with, well, not really in some ways, which we'll explain about, was the wicking that we ended up getting by the end of the day. Markets kind of are showing they want to fill some gaps before they potentially sell off. They've actually got some latent buyers in there. But look, the news just keeps flowing in and nothing's good about it. NVIDIA, this chart should prove to you that it has absolutely nothing to do with reality right now. And when you see that closure, of course, it points towards further upside potential in NVIDIA. This is what happens when people get on board an idea. It is detached from reality. Wall Street people are coming out now and saying, we're upgrading it. It's all great. Everything's all great. I love the stock. I'm a Shield owner. I've got the 3080. I love the NVIDIAs. I've always been in gaming and that kind of stuff. So I really like NVIDIA as a company. I think it's awesome. I love the stock. I like a lot of things. I don't like the price in this current market. And if you look it up, it's going to be difficult. So again, more of a trade than an investment, in my opinion, at these prices. You've got to be careful. Some notable levels for the week ahead. Things like gap fills, just in case it keeps going. But I expect this to probably have some kind of epic blow off, where markets just kind of, maybe it'll do some epic rally and then it will dump massively. And I'll be following it should it occur, and I'll tell you what I believe could happen next when that does occur. Let's look at the DAX. So the DAX has been heavily shorted for a while by retail, and retail have been getting absolutely smoked. First sign of weakness, decent close for the DAX. We saw higher highs over here. We saw a nice little low. Obviously, a lot of people will see this as kind of like a Wyckoff turn. It could be the beginning of DAX starting to struggle. And I certainly think that was a very notable short there that happened through the Friday session. Rallies should be met by sell demand at this point on this particular pair. Let's move over to the ASX. This is the Australian market for anyone that doesn't know. This market continues to look weak for me. Copper falling off a cliff. I don't like this market right now. I want to sit down here. I am Australian, so I know my stuff about the Australian market. And I'm starting to cover it for the Australians out there. So make sure you subscribe if you're Australian and you're not subscribed. You've got to do it, guys. And yeah, we'll cover it. But yeah, I don't like it at the moment. It's looking bad. Let's move over to the Qs. Let's go to the American market, the best market in the world. So we've got the Nasdaq versus the S&P 500. We know that this is on that trend line. I've been talking about this one being the key critical trend line of the year to be watching. Keep it on your charts. Basically, it's just showing us that at the moment, we don't have any real trend. We're not seeing a huge amount of risk off in tech yet. But if we do, we'll see it represented in that chart. Let's move over to the US 30, still sitting on a demand zone for the week ahead. So it's basically at a level where I could see buyers recommitting. Here's the Qs and the numbers if you're interested. And obviously we have a lot of gaps that could be filled. Here's the Nasdaq. So when we go over to the Nasdaq, we'll do more in depth with the S&P 500 in a moment. But the Nasdaq came off some kind of like daily levels. And we also saw that the Nasdaq's got a little bit of latent demand in it. I've got some watch reaction zones I think that are important for the week ahead. So definitely put those on there, what I would call extreme levels for the week ahead. And you can pack them with of course, your Q zones as well to check them out as well. SPX, now this is where things get pretty wild. Take a look at these gaps. Unfilled gap, unfilled gap, unfilled gap, unfilled gap, unfilled gap. There's probably another one I'm missing. So there's a lot of gaps. I think notably this one here, the 40-12. Now that's the one that I think bulls will be focused on this week. I still think that this has to fill at some point. I don't see this 40-80, 40-90 not filling. The question is, do we kind of rally, dump into March and then rally back for that later on? That's the conundrum. That's the hardest point. Look at these wicks. Each day we kind of dump and then we see buyers. So there's clearly someone trying to purchase it there. Otherwise, it was bad news. Let's face it, the Friday was shocking and it still managed to hold up. Now, was it just options or was it Wall Street saying, hey, we're prepared to maybe pick this up at the moment? Well, smart money, we know flows going back in. I don't have all my money flow indicators at the moment, so I'll update you when I've got those. But yeah, some of those, it's very interesting. Expected weekly options highs and lows. Here's your charts. For the weekly close, we didn't quite close on the lows. Again, we put it in with the wicks that were here. So that's semi-bullish, semi. Overall, still, we are negative for the next couple of weeks, but we want to see rallies so that rallies can be faded. That's the main thing. So what did we hit through the Friday zone? We hit one of the most traded zones of the last kind of 6 months, which is super critical level. We also hit into the wicks that we saw strong buying off before. Remember, these were zones that got absolutely just ripped last time. So we're basically in an incredible demand. And then we closed on the weekly low of the previous week. So we basically closed, or previous weeks, we closed on a critical zone. We closed at a really big level. And we know that if markets are going to rally, the fight might be around that 40-12 zone. So this is where I expect them to kind of skip back in. If they fail here, back down to 390 we go, and possibly even like a 389 or something like that. And at those points, then we might see buyers. There's a lot to like about zones down here, but I still like this zone as well. So for sellers, I mean, you have no reason to dump the position yet. I mean, there's no strong reason other than hitting that super critical level. Where I think sellers may have to give up a little bit, it's going to be around this zone that we've now broken through. So we've got a high low here. We've got a lower low. We're looking for a higher high if you're a bull, and you want to see it breach through this zone. If that happens, then pullback's probably met by buy demand. We move towards that kind of 40, 80, 40, 90 zone. At this stage, there was some nice action on the really small timeframes. And for anyone that got it, congrats. That was a pretty nice pickup if you were patient enough. Basically, markets just got obliterated down after the news. They rallied, they dropped, they rallied again, they dropped. Nice switch here, and we saw some buyers. I'd like to see that commitment come through into Monday, and I really want to see this level tested in the next week. Now, sellers could be here. So I think this is a very interesting zone to see sellers coming back in, maybe some nice resumption. I like to always believe that patience is the best way to go, and then you react to key levels. So I believe we're at a key level. I think there's a small reaction here towards the bull side at this stage. I'd like to see that follow through just because I think that's the right thing to do, but we'll find out. And then, maybe some resumption down. There's also the case for this to occur and then resumption down. But the data does point towards March and the start of March, the back of Feb being a bit rocky. And that's what we're seeing currently represented in these charts. Let's have a look at the options. Again, I just wanted to point out here that although it was underneath the max pain, because max pain was 402, it ended up at 396. It still did an amazing job not paying out the 395 puts. So again, market manipulation at its best and finest. That's what they love to do. Let's refresh this now. And we'll move over to the week of the head, which is the 3rd. And we know that there's a lot of 390s. So 390 should act as a basing. We've got a 405 max pain coming into this week. Nothing unusual about total option interest amounts. But yeah, 390 and 385. So down here, we kind of have our base structure. We know that markets should rally if they want to make the most out of the put structures that are currently in these markets, like the most amount of profit. But yeah, that 390, 385, key critical zones. If markets do end up falling off further, I think we know where the buyers could be recommitted. And of course, we'll bring that up throughout our daily show during the week. Bitcoin, yeah, is just kind of still knocking off those highs. We know that we've got pretty big switches that occurred at our first level. We reported on that. So this is definitely where the bears sit. At the moment, the bears are winning. They haven't really won yet. I think that this is a super important zone. So I'm saying watch reaction here, but more importantly, between this white line, this purple line, this is truly where I think the switches occur. If like something like Bitcoin is going to really weaken, has to get through here, new lows, and then I believe it'll actually dump off. So if you're someone that wants Bitcoin to go down heavily, you really want it to go down underneath this zone. If you're a buyer, somewhere in these zones here is very, very interesting to you. And of course, if you get closures above this watch reaction area up here, I've still maintained that if that occurs, I believe the potential is in the 30,000 plus line, and that's going to be pretty damn big. Let's move forward to the week ahead in terms of news. What else do we have going on? There's not too much. CB consumer confidence. Then we scroll through here. We've got ISM manufacturing PMI, Wednesday, March 1st. And then these are all New York times, by the way. And then we have ISM services PMI, Friday, March the 3rd. So it means that the week after that is when we see the jobs number, and that's going to be the big one, that non-farm jobs number. I think it's a pretty important piece of information and certainly worth checking out. If you haven't already, come and follow us over at FX Evolution on all of our socials. If you're also interested, you can jump in and get some free trading cheat sheets. And of course, you can also join us in our community of Discord traders. So it's always good to see so many people joining our community. Also, just a quick reminder, if you haven't already checked out Tiger Brokers, why not consider them? Hey, if you're from Australia or even New Zealand, I think some of the offers down below are so good that you can just literally open an account, put a cent in there or more, and then get some of the extra bonuses. Thanks so much for watching. Subscribe, smash the like button. We'll see you in the week videos, and I'm looking forward to another exciting week. It's great to see some of the plans playing out. Bye for now.